Hello, everyone, and welcome back to the PetroNerds podcast. My name is Trisha Curtis. I am the CEO of PetroNerds and the host of the PetroNerds podcast. Today is Tuesday, January 20th, 2026. We are almost 3 weeks into the new year, and it feels like we are several months into the new year. So this is episode 149 of the PetroNerds podcast, and this is a heavy-hitting, jam-packed podcast. I had a few in the queue, and I moved this one around because I think this is really timely. So the podcast you're going to listen to today, this is a very, very energy dense. We pack a lot into a little bit of time. In the talk that I gave to the Petroleum Alliance of Oklahoma, this was on November 13th, and so it was the second day. I came in and gave a morning talk right after coming in from London and talked to the Petroleum Alliance group. Brooke Simmons, who runs the Oklahoma Petroleum Alliance, brought me in. Can't thank him enough. That group just gets literally like that conference. It's phenomenal, but it manages to get more phenomenal every year. Really, really good group of folks. And I was speaking to, and I say she, and you'll have to forgive me, I was actually looking at Doug Lawler and Shelley Lamberts, she's now the executive chairwoman for Continental Resources, and she had spoken just before me. She was kind of the keynote in the morning, and I was the follow-up keynote. So this is a really, really heavy-hitting talk that we cover, and really timely because I talk a lot about where oil prices were over the course of 2025 and the incredible geopolitical risk in the market that's not being really priced in. And so today in this introduction, before talking a little bit more about what we talk about in this podcast, today in this introduction, I want to spend some time. The elephant in the room is obviously that the stock market is down today significantly or significantly, maybe even overstretched, almost 2%. Gold is ripping higher, and that is on the back of Trump's comments on Greenland and really the market concerned about tariffs, right? The threat of tariffs and the fact that we have these the increasing of tariffs. So this is all happening as Davos is taking place. So you have lots of interviews and stuff taking place. I will just say that Secretary Treasury Scott Bessent was on TV over the weekend, and he said essentially, so he was in the U.S. on TV, and he said over the weekend that, this makes sense. We're going to do this Greenland thing. And then last night, when he was in Davos apparently we all have our houses in Davos, but the U.S. house, he was at Davos, and I heard him late last night on Bloomberg, and he was taking questions. And so I didn't hear the whole speech, but late last night he said, hey, this is all going to work out. This is also how the market reacted during Liberation Day. So he was downplaying it. But with that, we don't really know what's going on. There's a lot up in the air, other than if you're looking at the market, oil prices are not really pricing that in. That they seem to be relatively steady, but the geopolitical risk premium that I said in last week when we had the podcast, which, by the way, awesome. Kudos to the panelists I had on last week's podcast and the intro, because we have over 1,000 listens in days on YouTube. So that podcast is just crushing it. If you have not listened to episode 148, please tune in. That is a very, very incredible panel that I did in Houston with Ron Gusick, with Liberty, with Andrew Navanti, with Calpine, and with Sheldon Burleson with Rockcliffe. So it is a round the world trip on AI and power. So absolutely worth a listen. But we're hoping to match those numbers this week because in the introduction of that podcast, when I talk about in Venezuela and the fact that everybody and their dog became an expert on Venezuela overnight, what was not happening at the time, because the everyone was still focused on Venezuela, was Iran. And so what you haven't heard over this weekend, because the news flow is talking about Greenland, is that we still have these protests in Iran. So, when the effective seizure of Maduro took place in the first weekend, which is not that many days ago, folks, of this month, we're on January 20th. This took place, I think it was January 3rd. So not that many days ago was the effective seizure of Maduro. The stock market totally sloughed this off like it was no big deal to the stock market. Obviously, the Greenland comments are a big deal to the stock market, and because they involve tariffs or potential tariffs. And so the stock market's selling off on that. Oil prices, though, as you remember, initially went down on the seizure of Maduro. I think they should have gone up. And then you had, then at the same weekend, though, on the Air Force One, Trump is commenting on the protests in Iran and getting involved. Now, we didn't get involved, and we didn't do anything to Iran. But the stuff that came out of this, one, they have an internet blackout. So you're still not seeing things. The communication within Iran changed, and getting that communication out. So you had to follow Twitter and you had to see the little bits of news that was finally getting on to TV and getting onto the stock market, which was doing a really deplorable job covering this, because the death toll estimates range from 3,000 to 20,000 of the people that the Iranian regime has killed in these protests. So really, really sad, very devastating. And apparently what they were doing is essentially, if you had a loved one, which were typically men, because men were protesting in Iran at the end of actually December, in the beginning of this year, they were protesting, and they were protesting based on inflation, and that they didn't have jobs and they couldn't afford anything. And so they're protesting about the state of the economy within Iran. And so lots of men. And when you see the footage, you see thousands and thousands of men on the streets. Well, clearly, it wasn't this past weekend, but the week prior, last week, Iran said, hey, we have these protests quelled. Well, their answer to quelling those protests was to literally kill people. And so they would call up family members and say, your son is, or brother, whomever, father is going to get tried. And then they would get killed the next day. So I just want to remind folks that Iran, I believe, is still a regime that stones people to death. They are a regime that does executions. And to have estimates as ranging from 3,000 to 20,000, that is just massive. There are a lot in that kind of 12,000 range. And clearly, if you look at footage on Twitter and everything, you're seeing tons of body bags. Sadly, the no one's talking about that anymore, because now they're talking about Greenland. And so I would say, from a geopolitical risk standpoint and an oil standpoint, it is really, really, really important to put that into context. Excuse me. So that's what I'm here to do today. So right now we're looking at Tuesday. It is the evening of Tuesday, January 20th. This is episode 149 of the PetroNerds podcast. And so WTI right now is 60.34. Now I just saw, this is what I saw on CNBC. I just saw a 59 handle. So we're flirting on this, but we've sort of firmed up ish around this $59, $60 level. Now that is despite the fact that we have these short positions on Brent, which I believe I talked about in the introduction of the last podcast, is that we do have these short positions on Brent. Those short positions, in addition to just the sentiment you come into in the first part of the year, in the first quarter of the year, which is not good for oil demand. It's just never a great quarter. All this is sort of weighing on this. So that's weighing. And then as you'll hear within this conversation podcast, is a lack of understanding of the market that's not aptly pricing in geopolitical risk premium. So 60.34 for WTI. We're looking at 64.13 for Brent. I had just seen, just hours ago or yesterday, $65 Brent. You're seeing $3.85 for Henry Hub. So that is firming up a smidge, not nearly what we had above, $5.50 in December. However, we did have a snapback in natural gas, and that is because we are seeing some cold snaps and an Arctic move come in. And so really, this has this is weather driven, right? Natural gas right now is extremely weather driven. We're seeing the consistency in LNG exports, but we're also seeing the consistency in production. Dutch TTF, also really, really important, because that was hanging around $9 and $10. We're seeing that snap up to over $12 an MCF for Dutch TTF. That's European natural gas prices. So that is going to be an issue. And so I cannot emphasize enough within this podcast and talk at the Oklahoma Petroleum Alliance, you're going to hear a lot about geopolitics, right? I condense this as much as I can into China, Russia, everything going on in the geopolitical space, Ukraine. But really important to point out is, in the last several weeks, this war in Ukraine, which again, you're not hearing much about that either, because the news flow is focused on Davos and Greenland. But that war right now that's taking place, Russia is really hammering Ukraine on the power generation front. So they're taking out the ability to get natural gas to home. So natural gas infrastructure, they're actually hitting their production, what little they have, as well as, so it's power generation, it's electricity. So very little power. People wake up in the morning at 2 a.m. when they have power for a little bit and do stuff, and water. And so no water, no power, no heat. So really, really big deal, because the temperatures are extremely cold in Ukraine. And you're hearing a lot of stuff going on within Ukraine where Zelensky has called out the leadership in Kiev for not preparing for this. This is an ongoing war, but clearly there's issues within leadership and things going on, and power generation. And when I say everything is everything, or energy is everything, folks, this is what I'm talking about. So very big deal. Okay, so Dutch ETF is up. This should cause some angst in Europe at least. But we have gold just ripping higher. I mean, if you aren't seeing the geopolitical risk premium in oil, you are damn sure seeing it in gold. We're seeing gold prices at 48. I mean, you're almost going to kiss 5,000 any moment. It's 48.20 for $4,820 an ounce. Now we did see silver. It looked like it was nearing 95. That's pulling back a smidgen, and then we're seeing copper kind of hanging out this $5.80 handle as well. So the 10-year yield, though, importantly, we're seeing this kind of across the board. Japan, UK, everywhere, yields are going up. And so you're seeing the 10-year yield, the 10-year at 4.287. So this is what the market is, right? So you have these yields pushing up, you have the stock market selling off, and you have oil price at $60 a barrel. And this is the PetroNerds podcast. So we'll focus on the PetroNerdy side. And really, I just want to, the big things kind of in the market that you're not hearing about because of the geopolitical focus, or is not enough on geopolitics, right? It's not enough on Iran. We are hearing a little bit more come out. I continue to hear these folks talk about peak shale. And I'm not saying that at $60 oil or $57 handle WTI, you are not going to have issues with peak shale. You can. However, that is price driven. That is not rock driven. And so what's gaining headlines right now is Harold Hamm, or Continental Resources. In fact, actually laying down rigs are saying they're not going to be drilling in North Dakota. Now, you have a substantial discount to WTI in North Dakota. It's several dollars, $5 to $7 for your discount. So absolutely, when oil prices are $55 or they're low 50s, this probably doesn't make sense to necessarily drill and complete wells in North Dakota. However, if your drilling and completion costs are really low, I would argue that drilling and completing wells, as I said in the last podcast, DAX, drilling and completing wells and not bringing them online might be an answer or an option. So just something to think about. So you're going to hear a lot of talk within this podcast, heavily focused on oil prices. I adjust where oil prices are at, the negative sentiment for oil prices, U.S. shale, the incredible productivity and the just the resiliency of U.S. shale really over the course of 2025 that people were this unexpected kind of grinding forward. I would say it's not impressively resilient in the growth that we had, but it's really important to appreciate that. And that's where I think this kind of sentiment and rhetoric is getting, is where when you hear Harold Hamm and everyone talking about Continental pulling back in North Dakota, then everyone's calling the Rockies dead and peak shale. There is a future podcast coming that I was going to drop this week, but I chose to drop this one because it's heavily focused on prices and geopolitics. But that podcast, the one I did at the Denver Earth Resources Library, which will be very soon that I'm going to drop, you're going to hear a lot about the Rockies in particular. And I think that this kind of sentiment right now where you have Harold Hamm pulling out or saying that he's not drilling, really that's weighing on this, like, okay, well, we have peak shale. And I beg to differ. And the reason I think it's so important to think about that right now is that that's the sentiment, right? That's feeding into folks' narratives. And that was feeding into folks' narratives early in 2025. And it impacted the way I think the Saudis thought and impacted the way the market was thinking. So from a rock standpoint, we definitely are not at peak shale. I think I beat that horse, that dead horse to death in many, many podcasts. Not beating horses. Sorry, didn't mean that. So we beat the dead horse on I don't believe that it's peak shale from a rock standpoint. Now, in terms of what we have left to give and the growth we're going to see, that is going to be price determinant. So that's important to think about. But really important in this context is oil prices, is that, look, we have $60 oil with all the geopolitical volatility that we have, with this seizure of Maduro, with the protests in Iran, with the ongoing war in Russia, all this crude oil on the water that everyone is talking about, that the IEA is talking about, that is weighing on this glut on the market, that is all Venezuelan, Iranian, and Russian crude oil. This is all sanctioned crude oil, illicit crude oil that is moving via illicit Russian tankers, which, by the way, I've been doing some work on Russia. And that is just such, the Russian side, the energy side of this game is so much more resilient than people are giving credit for. And I'm not saying it's a good thing. It's a bad thing. But if you were thinking that Russia is down and out and they're going to bow over the course of this year because their economy is hurting and because they don't have any options, I think you are very short-sighted. I think the market is short-sighted on that. We're not even talking about that right now because everyone's, again, focused on what's happening at Davos and Greenland. But it's really important that I think Russia has a lot of quivers left in their energy, like in energy coercion tools, should they want to fire them. And I think it's really important to realize that they have done a pretty, especially moving around sanctions. And again, I'm not giving credit to them, but it's pretty impressive what they built in terms of an alternative shadow fleet that's moved around all the sanctions, which have basically made the sanctions completely ineffective because Russia has all these shadow fleets and tankers that they're moving all this illicit crude oil with. And so all that crude oil on the water that's supposedly weighing on price, that's all this sanctioned crude oil. And so I think it's important to realize that that means that we have this geopolitical volatility and all that's sort of working and holding, prices at a muted level, because we have this crude oil production. Now, if that was to get really sanctioned and enforced, we should see prices more at 65 or 70. And I think it's really, really important that we start talking about that seriously, of what is good for U.S. production. How do we maintain 14 million barrels a day of production in the U.S.? We do that with $65 or $70 oil at a minimum. And I think that is okay for the consumer. I do not think that hurts the consumer massively. Up until today, we had a decently ripping stock market, and we still have kind of a hot-ish economy where we have this inflation. Now, I'm not saying I want to add to that with higher oil prices, but $65, $70 oil prices is important for the U.S. economy, given when you're producing 14 million barrels a day, that's a huge boon to the U.S. economy. So that's really important. And I just want to point out that 14 million barrels a day, that is almost as much as Russia, Venezuela, and Iran combined. So on paper, OPEC is saying that Iran is producing 3.2 million barrels per day. Now, they're probably producing a lot more than that, right? They're probably producing more like 4 million barrels a day. I do think a decent chunk of that, or some of that, is getting into Iraq, as I mentioned before. So that is a big deal. But so you have that, right? So you have the Iran piece where they're producing this, and almost all the exports are going to China. And then you have Venezuela producing about 1 million barrels a day, which almost all the exports were going to China. And then you have Russia producing on paper, OPEC has them producing under 10 million barrels per day, like 9.367 million barrels per day. That's not correct. If you're looking at total output with liquids, the EIA has Russia actually, as of September, producing 10.6 million barrels per day. So really, they've barely taken a breather since the start of this war in Ukraine. And really, they've barely taken a breather since 2014 when they seized Crimea. So really important to appreciate is that Russian output has been very, very steady. And so if you are trying to look at and leverage your points of strength, the U.S. point of strength is the fact that we don't need all this global output. Now, you can certainly impact oil prices, and it would be a problem to take several million barrels a day off the market. But the U.S., this 14 million barrels a day that we really need to maintain, is just shy. That is Russian and Iranian output combined. That's what we are producing. So really, really impressive from the U.S. standpoint. But slightly higher oil prices would be very, very beneficial to especially independent producers, which I don't think these smaller operators are getting kind of the attention and love they probably need in Washington. And the appreciation, maybe from the understanding from the Trump administration, is that this is he appreciates that the 14 million barrels a day, and this is great. But that if you want to maintain this and you want to grow this and you want to continue to give all this benefit to the U.S. economy, not going after oil prices is a big deal at this point, because this is what is a huge sector and a huge boon to the U.S. economy. Okay, so this podcast, again, this is the presentation that I gave at the Oklahoma Petroleum Alliance on November 13th, 2025. This was an absolute blast. You'll see it's very heavy hitting. Great questions from the audience. But two things to point out, folks. The last podcast went very well. So if you haven't listened to that, please tune in. The podcast is just ripping. I have folks that are in the queue on sponsorship. But if you're looking to partner with PetroNerds, or if you're looking to get deeper insights, reach out. I would love to speak with you guys. A lot of what I do is talking to a lot of executives one-on-one, a lot of CEOs, a lot of C-suites, of just having a touch base where we talk on a monthly basis or a weekly basis, or frankly, whatever you need to really go through all this information and have a conversation about it. So please reach out. You can reach out directly on the PetroNerds on the contact us page and pop me an email. So two things coming up. We have a great podcast in the queue. That is you'll hear some of this because I'm coming back from London in this talk that you're going to hear today. But I have that podcast that I did in Oxford at the Oxford's Oil Day for the Oxford Institute for Energy Studies. That is a forthcoming podcast, as is the Rockies podcast I did with Tad True and Nathan Anderson and Joe DeDominic, Rockies Focus. That will be coming down the queue. And also coming down the queue, two public talks and presentations I'll be doing is February 18th. I will be at NAPE. I think it's one of those opening morning sessions where I'm on a panel with some other folks and we're talking about geopolitics and everything going on. So we will be talking about Venezuela. We'll be talking about all of this. And I think listeners and folks know I am willing to take the hard questions that a lot of other folks would like to avoid. So please attend and please throw those questions out because I'm happy to take them. So that will be awesome. Very much looking forward to it. It's the first time I've spoken at NAPE. And then February 26th here in Denver at Liberty, the Denver Energy Network and the Women in Oil and Gas Association is hosting me for a deep kind of 2-hour long. It's an hour presentation plus fireside chat with opening it up to Q&A. It's a networking event. I think it takes place at 3 p.m. at Liberty Energy. So please get registered for that, folks. It's all over LinkedIn. I believe you can go to Women Oil and Gas Association or the Denver Energy Network. It is also sponsored by First Turn Capital and Liberty Energy. So this is going to be an awesome event. I am super, super pumped for it. So with that, folks, thank you guys so much for listening. I am very, very excited for 2026. It is already a rocking and rolling and volatile, energy dense year. We're going to have a lot in the queue, and please look at PetroNerds for a resource. Talk to you soon, folks. Bye.
All right, guys, let's welcome Trisha Curtis. She's got some great updates for us. So thank you very much, Trisha, for being here.
Awesome. Thank you. All right. So admittedly, I am a little jet lagged, and I've been up since like 3 a.m, so apologies. So I may speak a little slower for you. But at the risk of eating into my very few minutes that Bert gave me, which is he gave me like 25 minutes, at the risk of that, I want to say that Harold Hamm's book, I've met and seen him many times and just always loved him, partly because that incredible work ethic. I idolize people like that, Chris Wright and Peyton Manning, because their work ethic is off the charts. But in Harold's book, if you read it, he's got like this oil, and I love the way he says oil, but oil, like his accent is perfect. But in the book, there's like this little scribble, and it's like oil. And I remember cracking open the book after going to his book thing in Denver, and I thought, I have a production chart, back in the day when my dad pumped oil wells and you had the pie chart, and that was a production chart. And I literally have scribbles of like, not scribbles, but like a little map of Saudi Arabia and rigs and everything. And so if I write a book, that's going to be inside of my covers, my scribble. So anyways, that's that little story. So I am in from London, and I will say there was a lot going on in London. I just saw $58 a barrel this morning. We've recovered about 59. Incredible volatility. We just had the International Energy Agency report drop today. That's why you're seeing prices drop, is because they forecasted another pretty big, I would say surplus, but not so much surplus, it's oil on the water. And I have to say, I wouldn't say this is unprecedented in the lack of uncertainty in the market, but pretty high. This year, I've experienced a lot of folks within the industry, an incredible amount of pessimism on oil prices, and a sincere lack of understanding of the total global market. And I would just say, if you're a CEO outside of the oil and gas industry, your probably number one focus right now is geopolitics. Absolutely, it's your number one thinking. It should be the same in the oil and gas industry, because there's for good and bad. But we have a lot of supply in the market. We have a lot going on geopolitics, and we don't have a serious understanding. And last year I was here right after the election, and I told you there was a new sheriff in town. And there's damn sure a new sheriff in town. Because while you may not love oil prices, the whole ESG movement absolutely needed to take a back seat. And we had gotten way too stretched in terms of climate policies and everything. So, we've really moved in the right direction in terms of that. But we've also done things like increase LNG exports. And that has increased directly right now. We're seeing that in price. And we have this opportunity to drill and complete more oil and gas. Now, Trump is not controlling oil prices. However, there's a lot of impact to the market, which we'll get into. I don't have time to show the slide, but if you have not listened to the PetroNerds podcast, please do. Ham has been on it. I need to have him back. It was such a fun conversation. I need to have her on it as well, because that would be really fun. So big takeaways, and if I can get through all of them, we're going to talk about oil prices and production, try to answer a lot of questions you may have very quickly, talk about this pessimism. Really do think there's a lack of market understanding. And part of this is because our industry has done very, very good at producing oil and gas. That has not been clearly understood within our industry. And I can tell you, absolutely being across the pond, not understood at all. I will absolutely go out on the leg right now and tell you, I don't think Saudi Arabia expected us to be producing 13.8 million barrels per day. They didn't. They had us capped a long time ago. And that's a big deal for the market when you see that gap out. I was in a room with some Saudis just recently, and I don't think they were very happy with my presentation on U.S. shale. So natural gas prices, those are ripping. Really, really important. I'm just going to say this before we even get into it. 452 nat gas. That's awesome for the industry. But I got to tell you, who do you think folks are going to blame when their electricity prices are going up? They're not going to blame wind and solar like they should. They're going to blame natural gas. And that is because natural gas, the consumer is getting charged about $19 an MCF, as opposed to the, sometimes negative prices you get in the Permian Basin. So really, really important that the natural gas and oil and gas industry have to get involved in electricity. They have to be vocal. They have to be talking about this. And really important, we have to have the back of coal. And I know it's hard for people to think about, but we do. Coal is what shaves off those peak prices and gives you a backstop. And we have been decommissioning coal in the grid. I'll show you that. And that has led to a direct correlation. When you add that wind and solar and you decommission that cheap baseload power, you get a rise in electricity prices. So price of stock, sanctions. Sanctions are a big one. We have real sanctions on Russia now. Now, we have until November 21st for those sanctions to get implemented. But you will see that Rosneft and Lukoil are the two largest producers in Russia. And importantly, these sanctions include them and their production, but also all their subsidiaries. Gunvor wanted to buy them. Gunvor is owned by a Russian. So the Trump administration said, hell no. And so we blocked that. And essentially now their subsidiaries can't do it either. And so when we talk about all this oil on the water that everyone's talking about, a lot of this is sanctioned crude. So a lot of this is Iranian crude. A lot of this is Russian crude. And importantly, we've had changes in flows. So in the past few years, when we have risen oil production, so has the rest of the world. Look at Brazil. Look at Latin America, that increase in output. And so when you move flows, you have to put it on the water. And so we have just some longer shipments, which leads to more oil on the water. I absolutely think the market is overselling. I think the market's way overdone on this oil on the water. I think you have a lot of short positions pumping this narrative. I don't think it's accurate. We should easily be at $65 a barrel, easily. And that makes me bullish. And I'm not known to be an oil bull, but that's really important to think about. Okay, and we'll talk about geopolitics, China, we'll get into that, and we're going to close on electricity prices. So here's your production. That's that 13.8 million barrels a day, 132 BCF a day of gross withdrawals. Really importantly, you've seen this chart, you know it. It's that last couple of years of that grinding forward. It's not massive exponential growth, but it's a grind forward. And I would say even folks probably in this room didn't expect that grinding forward because we are drilling less wells. We are just drilling with longer laterals and we're better at it. And that has incrementally added production. Super important on natural gas, and I am very bullish on Oklahoma and Anadarko. I think it's awesome. I love this state. I love coming back here. Every time I fly in, it's awesome. It's a great airport. The people are incredible. And you have good regulations. This state should be producing more, I think. And I think with natural gas prices and NGL prices, there's more that can be done. And then we have to really think about natural gas prices really giving a lift to oil. And it can help offset some of this softness in oil prices that I'll just tell you, average oil price this year, you probably wouldn't have guessed that it's been $65 a barrel. So it has not been nearly as bad as the market has sort of told you how you feel. And really, if you're running through that environment, you're doing okay. And there has been a lot of opportunities to hedge closer to 70, and there's probably going to be some more as well. But natural gas prices really help, especially as the gas drive for a lot of oil areas, condensate, you name it. We have a lot of running room with natural gas. So we're going to be watching the space closely. That is oil production, and since 2008 against prices, that gap out as of late is important to appreciate because we are also profitable. The industry is largely profitable 2020 onward, and that's something new than we haven't had historically. And so we're able to ride these lows much better, even though everybody's grumpy and everybody's complaining to me all the time. We're doing a lot better with a lot less. So that's the rig count. We're at 548. I don't think we need many more. We came down. We didn't come down nearly as much as people projected. And I'm going to call it Diamondback here just because they love to be, they're very vocal about this. But in May, they came out with that letter and said, we're dropping rigs, we're dropping a frac fleet, and, everybody else is going to drop too. That didn't really happen. Everybody else didn't really drop too. So we did drop rigs and we dropped frac fleets, but not massively. If you chart rigs and frac fleets, those are really tightly correlated with oil prices. That frac fleet is really important because we've nearly doubled horsepower on the frac side since 2020. So in the past 5 years, that's pretty impressive. So you don't need as many frac fleets. You don't need as many rigs when you're drilling, 3, 4, 5 mile long laterals. And we're doing it very efficiently. And it's really about completed lateral feet. That's just the rig count in line with oil prices, how tightly that correlates really nicely. And then here's one of your money slides. If you take nothing away from this is a pretty nerdy one. This is a good one. That is oil production in black. That orange line is lateral length in feet. And that purple line is your rig count. So as your rig count has come down a little bit, your average lateral length across the US has come up. That has offset that production. And that is your oil production, all really nicely in line. Most people have missed this in a deep fashion. And it really just tells you that steady march higher for production. If you add completions, so the black line there, the production is in gray, and that black line is completions. We've really held up on completions. We have not dropped those off. So when people are expecting the U.S. to drop output, they need to be looking at completions. And this is absolutely what the Saudis missed, is all of this in this past year. I would say largely people outside of the U.S. have really missed just this overall year of production. We're just doing a lot more with less. So more is more, right? I'm a big more is more fan. More sand, more water, more stages. But really, this is super important because that profit mass per fleet is telling you how much as an industry we're pumping, but that really is kind of your a proxy for horsepower. And then more importantly is that tier 2, tier 3, this whole we're running out of acreage. I've never bought that. No one's gotten together in a room and decided which is tier 1 acreage. And I know a lot of companies who had so-called tier 2 or tier 3, and then they flipped it. They sold it to another E&P, and now it's tier 1. And so what happens is, and for a production standpoint, yes, this matters to price. We do have to have a certain price to make this work. But when a private company looks at an asset, they look at it differently than a public company. They can take a little less rate of return, and they can look at it, they can tinker with it, and they can prove it up. And often we can pump more sand and more fluid down that well, depending on the reservoir and the geology and everything, and we can get some out. And I see that when I look at the productivity curves, when I normalize them, when I drill down into the basins and the reservoirs, I see that every time. And the data is the data. And if you're studying the US and you drill down by basin, you really see it. That's Oklahoma oil production. I just put that out. I do think there's a lot of running room. It's still good. It just should be a lot higher, or could be a lot higher. Texas and New Mexico, really importantly, I was speaking in Oxford and I knew they were going to say, hey, but you're not growing. It's only the Gulf of Mexico that's growing, or Gulf of America. And it's not. Look at New Mexico. That is 2 counties, Lee and Eddy County, are producing 2.3 million barrels per day. And I've been told for the past 3 years, everyone says, oh yeah, but it's going to peak. 3 years ago, it hasn't peaked. Okay. This is some of the best rock in the entire world. Just really, really important. And it has gone up regardless of what prices are at. That's the average lateral length in the Permian. Really incredible. That's 11,400 feet, but we have many, many wells that are much, much longer than that. U.S., Russian, and Saudi production. So we're gonna switch gears, and I'm gonna just keep going until he shuts me down. So, okay, U.S. production in black. That's Saudi and Russian production in purple and red there. Super important is that's that gap. This is a geopolitical issue, right? They're not comfortable with this. The Saudis certainly are not comfortable with this. This gives us incredible geopolitical leverage. They clearly missed the last couple of years of production, thought we were peaking. And so they are about 10 million barrels per day. Now, the Russians are around 10, they're a little under 10 million barrels per day right now. But that really means that we've annihilated the oil market. We own the oil market right now. We're exporting over 4 million barrels a day crude. Together with NGLs, everything, it's actually not NGLs, it's 11 million barrels a day of crude and product, just in a massive amount. That's way more than Saudi Arabia. That's way more than Russia. So really importantly is that this is the slide I showed in Oxford, which was the elephant in the room, especially for the Saudis who were there. I think it made them quite uncomfortable. Okay, this slide you cannot share, but this came just today, this morning. This was the IEA oil market report that dropped literally this morning that moved the market. So this is your Russian seaborne crude exports by seller. And you can just see in the last bars there's a lot of Rosneft and there's a lot of Lukoil. And then there's this green, which is these new entities. So you can bet your butt that Russia is going to look at new entities. They're going to try all kinds of different ways to move this crude around. But increasingly, if they think that the Trump administration is going to slap secondary sanctions on them or enforce these sanctions, they're not going to want to take it. And so we are seeing India at least say that they're going to comply with this, right? And they're not going to take this because they won't lower tariffs. And then you see that this is their historical exports of these trading fleets. You can see how much is Rosneft and Lukoil as well. So this has a little more staying power than I think previous sanctions. Everyone should have been doing this a long time ago, but the point is it's being done now. This happened also in tandem with the European Union sanctioning crude. They actually sanctioned teapot refineries in China because China's taking over 2 million barrels a day of this crude and India's taking over 2 million barrels a day. And China's also taking well over 2 million barrels a day of Iranian crude. So they're just lapping up all this very cheap sanctioned crude. So OPEC Plus, another really big takeaway. Everyone in the industry, and I've got a nickel for every CEO who tells me, and I spend a lot of time with boards and CEOs, love them. They don't always pay me because we agree. Often they pay me because we don't agree. We have fun conversations. But just notice there, Iran and Iraq are producing a lot of oil. Actually, I think that Iraq, we have to be careful because I think some of this Iranian crude is coming into Iraq, which means we're probably taking Iranian crude, and we should not be. We should be fingerprinting those barrels. But Iran has a massive influence in Iraq, has been growing for the past several years. So that's really big. Iraq, if you paid attention to these OPEC Plus meetings, they keep saying that they want revised, they want their quotas revised, so they want to be producing more. And then Saudi Arabia, you can see 10 million barrels per day. This is what the OPEC Plus output increases. This is all what they've been about. This is about the Saudis taking back market share. And to be very honest, if I was advising them, I would have told them to do this. I would have told them to do this year as well. It was a decent market. It's not horrible. It's not amazing, but they took that lollipop
cut off the market a couple years ago, and they just want to bring those barrels back. And that's what they've done. And then Russia's getting a little squirrely because obviously prices are impacting them. Now, the trick with the Trump administration is they have to get this right? They don't want oil prices to go up too much, which they do need to let oil prices probably go up to 70. And I would like to spend some time with the administration explaining to them that it would be beneficial for this industry in this country to have $70 barrel oil. It wouldn't hurt the consumer. When you're producing 13.8 million barrels per day, you're a huge boon to the U.S. economy. And that message needs to get across the administration. I'm not quite sure they're getting as many smaller operators into DOE. I would like to change that. So, reach out to me. I'd like to, we can fix that. But, so they don't want prices to rise too much because that would offset the crude that they take off the market. So Russia would be okay to take a few million barrels a day off if they get $80 oil because that will just offset the revenue. So we have to be careful with that. And 80 might be too much. 70 is probably a really nice sweet spot, especially for production and for operators. And super, super importantly, we need to be thinking as an industry on a national security level of maintaining 13.8 million barrels per day. I do not hear enough industry leaders talking about what that means we have so much staying power, so much geopolitical leverage right now, more than any nation on the entire earth. So just massively important. And when you go to DC, you still don't hear enough people understanding 13.8 million barrels per day, that we're the largest oil producer in the entire world. So Chinese oil consumption and stockpiling, that's Chinese oil consumption. That is not real. Yes, they're 17 million barrels a day. No, they're not consuming 17 million barrels a day. They are stockpiling a lot of crude. So when I'm talking about those crude on the water and everything, also in the IEA report, they talked about China's taking more crude. They're stockpiling, which is a little bit of a red flag in terms of preparation. So they have always been doing this. Mao, Deng Xiaoping, every leader in Chinese history loves to stockpile. But this, in tandem with everything else, is a little bit, it's a lot. They basically probably have about 2 billion barrels of stocks, which is a hell of a lot. Here's our SPR. We are refilling it, but not as much as we should. And we do have a put. We do kind of have a Trump and sort of Chris Wright put on prices. I've said this for a long time, but you're not going to get $40 barrel oil. And I hear people in the field and service companies, they say this. It's Bananaville. We're not going to get $40 oil. We shouldn't. I mean, you could, but it's going to snap back in a minute. And we really shouldn't even have in the low 50s because we would be refilling the SPR aggressively. I wish the Trump administration would be a little more clear about this, saying, at $55 oil, here's what we'll do. But right now, we're refilling at just less than 1 million barrels each week. So it's about 3 million barrels a month. And it's a steady upward trajectory. That's where we're at right now. That is putting a floor on prices. And LNG volumes, this says 2023, but actually global LNG volumes, I'm just saying this because everyone talks about the global LNG glut. We only have a glut if we don't consume it. And there's a lot of nations in the world that absolutely need this natural gas. We just have to send the signals and help them. You have to develop the infrastructure. You have to develop the power to turn your lights on. People have to be able to invest in this. They didn't have that clarity and investment from the previous administration. They have it now, but they need to develop their power systems to do this. So we're at 53 BCF a day, 2023 and 2024. It's still a very new and nascent market when you're talking about a global market of 400 billion cubic feet per day. And now, so the reason you've had the big price spike is because we went from 15 BCF a day of exports to 17 BCF a day of exports. I think Toby Rice was in ADIPEC. He said we were at 19. That seems high, but we're probably even a couple BCF a day of increased exports is going to help you move the needle on price. So the Russian story, we're going to be 4 years into this war in Ukraine. This is a long time. Russia does not want to end this war. That's clear. China does not want to end this war. That is also clear. I'm giving you a very, very summarized version of this, and we can talk offline. This is super serious, especially from the China front. And you know what? The sell button on oil, this is part of the story of Trump met with Putin in Alaska. Oh, we're going to sell oil because we're going to have peace. He didn't say he was going to do anything. He didn't say, sell oil, we're going to have peace. He just met with him. That's all he did. He had a meeting, and he was going to have another meeting, and then things were going south. So he said, no, we're not having the meeting. So there's been a lot of misinterpretations of Trump on Russia. We're clearly sanctioning them. But this has been the missile and drone strikes of just this year of Russia on Ukraine. Really ramp up their missile and drone strikes. What they do is they send a bunch of missiles and a bunch of drones, and they decimate your airspace so you can't defend it. So at least a few of them get in there and they plink stuff off. Importantly, they target power generation. It's wintertime. It is really cold in Ukraine. So you hit power generation and you get chilly. That really hits the morale of the people, right? When you cannot turn your lights on, people are not happy. And they've been at this war for 4 years, and it doesn't feel good. So, Russia's really thinking we just keep at this, we keep banging home, and it is all about energy. Russia funds it with energy, and they target energy. Energy it's absolutely full stop everything, period. That chart that map on the right is your Russian incursions into European airspace. It is constant. These are drones in European airspace. Airports are being closed on a regular. This is Russia trying to up the ante a little bit and trying to see what Europe will do. And so far, they've done nothing. They've done absolutely nothing. So I just want to remind folks that we let Russia take Crimea in 2014. You had between 2014 and 2022 to get your ducks in order if you were exposed to Russia. And I would say the same things are happening with China now. If you are exposed to China, I would highly advise you get unexposed because all the warning signs are there that conflict is going to escalate. I'm not a warmonger, but I'm absolutely a China hawk. So Russia versus Ukraine power generation, really a direct one-to-one correlation. This is electricity generation in Russia that largely comes from natural gas. And that is electricity generation in Ukraine. That's the war. Knocked it out. And Ukraine's grid wasn't good before. It sucked before the war began. But now they lost a quarter of their power generation since this war. You can't make drones. You can't make the equipment to fight this war if you don't have power generation. And that's a really, really important thing is that we think about war fought on oil and we need to be thinking about power generation, how we make things, planes, ammunition, ammo, everything. So China had a big military parade on the back of a big meeting that they had. Kim Jong-un was there. Russia was there. And Narendra Modi was there. It was a big deal. They had a big military parade. And at the same day, Trump had a fighter jet flyovers, which was super cool when the Polish prime minister was there, because I was there and I saw them. It was super neat. So we do have some rhetoric, some upping the ante. This is an op-ed I wrote on China recently. Please check it out. It really summarizes all this work I've been doing on China. Essentially, China has 10,000 terawatt hours of power generation. They have 1/3 of the world's power generation. 1/3. Over half of that comes from coal. So 5,800 of their 10,000 terawatt hours. Globally, we have 30,000. They've got 10,000 of this. 5,800 of that comes from coal. There's no nation in the world that even has 5,800 terawatt hours of power. So that's really important because coal is super reliable, it's super cheap, and it's very dispatchable. So they have a leg up on us in a lot of ways that people don't even understand. This is global coal consumption and Chinese coal consumption. So if you're talking about CO2 emissions, I have a heartbreaking story for you. It is not happening. You're not lowering it because China's only going up. That is global. They're more than half of global coal consumption, 92 of 165 exajoules. Their economy is very much disjointed. It's bifurcating, meaning that the state-led technocratic industrial state is investing and growing, and the consumer is declining. So you can see cement production is a good proxy for construction, and you can see property sales just tanking. That's the consumer. And when the consumer doesn't have money and they're nervous and they can't make money and invest, they save it. And that means the government, the state government of China, has access to all their savings, and then they can direct the money how they want. And they are directing it into lots of industrial activity, massive technology, and really importantly, folks, they're not driven by profits. So they will dump a bunch of money into electric vehicles, and they will decimate our auto manufacturers because they make an electric vehicle that costs $10,000. And they have a long-term game here of basically just making sure Ford and GM are out of the game in the future. Because again, you make things with these companies. That's global electricity generation. So that's your 30,000 terawatt hours globally. You can see how it breaks down. That's the blue line is the US. The red line is China. So in the electricity game, the making thing game, we are screwed right now. We have got to get our act together because this is really, really serious. And we can count Europe out. They're in green. And you can see India, it's way below that. So we have an opportunity to really help a lot of other countries, but we need to get our act together here, which means more natural gas in the grid, keep the coal as the backstop, and stop putting the crappy wind and solar in. The wind and solar is coming from China. It is made from forced labor, and it is made from coal. And there's no excuse for it. It's a crappy form of energy. Once you put it into the grid, the people who pay are us, the consumer and businesses, and it's unreliable and intermittent. So I have a really hard time with it. So sorry for all those people that are pro wind and solar. US versus China, that's just your breakout of what it looks like today of, US versus China on by fuel. And you can see coal at their 5,828, terawatt hours versus our only 712. So in the CO2 debate, it's not even a debate. We're declining, they're rising. And that's what we look just stacked up. They have more than double our power generation. You can see that what it looks like again there, that's China. And that's the US. We have that wind and solar coming in. We have a lot of nat gas, which is awesome, but we've decommissioned that coal. And I'm about to finish here so we can do questions. This is electricity prices in red, and this is our grid, what it looks like right now. This is updated. That's yellow is natural gas, and then you've got that green line there is wind and solar combined. You've got nuclear, which is largely flat, and that's gray. You've got hydro, which is blue, largely flat. And then you got coal in black. And you can see recently it's went down and it's kind of moved up a little. There is a direct 1-to-1 correlation right now because we have decommissioned so much coal, you can see there in black, and we've added this wind and solar, you can see in green. And you can see the direct correlation. When you decommission the coal and you add the wind and solar, you get a rise in electricity prices. We had flat electricity prices for a decade. It was not until the Biden administration and all this ESG climate push with all these states shoving wind and solar into the grid that caused these prices to increase. And it wasn't just the wind and solar. It was pulling out that cheap, reliable backstop coal, which is really important because natural gas is awesome. But when those price spikes happen, if you have the coal, it can shave off that spike. You don't even have to use much of it, but it's really, really important because right now you can see where prices dipped a little bit. That is because you had a little bit of dip of wind and solar. The direct correlation is that strong because our grid the demand is that high. And we can't revitalize the defense industrial base like the Trump administration wants to do without getting this right. And there's a very, very clear thread in all of his executive orders. Everything he's doing is that he may not say China explicitly, but it is damn sure all about China. And with that, lastly, this is oil prices. Purple is unemployment. Orange is inflation. We haven't got inflation sorted. This is a problem. But I'm going to close with that. So thank you guys so much.
Let's give Trisha a round of applause. Fantastic presentation. I know we have some questions from the audience. So if you have a question for Trisha, please stand up, state your name, ask the question. Right here, Cameron.
Trisha, just curious on your call on 65, like just with the restocking on China, and obviously we're talking about from a population dynamic perspective in China, out of there, relative to U.S. production remaining flat. Like, curious what your balances are for 26 and why the call for 65 relative to that.
So I would say I do something with clients and with a lot of people when they ask me about prices. I try to get folks comfortable. If I was working with you in an E&P and I would say, I'd probably do 3 forecasts for you that or a state, even if you're a state of Oklahoma, state of North Dakota, that you better have a budget at 40, a budget at 45, a budget at 55, budget at 65. And it's that you have to have scenarios and you get comfortable within those. I say that right now we should be at 65. Absolutely. Given where current supply and demand, where demand has not dropped off a cliff. And I normally this is an hour or two presentation for clients. So I summarize this in 20 minutes, but we haven't dropped off a cliff for demand. We do have a lot of supply on the market. Demand has not dropped off a cliff. And we have a lot of geopolitical risk, a massive amount of geopolitical risk. So at a minimum, you should have at least a $5 risk premium on geopolitics, which we don't have. So I would say easily we should be at 65 and maybe even actually a little closer. But we have all this oil on the water and we have an exceptional amount of pessimism in the market and a lot of really crappy oil traders that have their finger on the sell button who don't understand all the fundamentals. But truly, when I was in London, somebody gave a great presentation at this Oxford meeting, and it was CME Group. And the guy always says, oil is not that volatile. And truly, it doesn't trade, that volatility. But these $5 swings or these $2 or $3, those aren't technical fundamentals. Those are just traders kind of moving it. So you have to realize that I would just say, absolutely, if I was to put my money on it and bet, we should be at 65. Next year, we'll have to see how this shakes out. OPEC did their increase of 137,000 barrels a day. And then they said, hold on, we're not going to actually do that increase in the first part of next year because they are starting to signal that they are concerned about what things will look like in the first quarter of next year. You had the government shutdown, which has just ended. We lack data. There's all kinds of things going on. I will say that in Europe, UK has 5% unemployment. They've got 3.8% inflation. It is not a good story there. It is a stagflationary story. And just talking to people in pubs, I would bet Nigel Farage might win by a landslide because it just doesn't feel good there for a lot of folks. So the economy doesn't feel good, but we are yet to be in full out recession where people lose jobs. If that's the case, then oil demand drops and then oil prices move.
Next question, Patricia. Kim?
You say that a lot of this crude that's going into China is going into storage, not being consumed. When does that stop? When does that roll over and they say, okay, we got enough? Dump the rest of that back into the market.
So if you study China, I don't know if they're going to have enough. Seriously, because they produce 4.5 million barrels per day. We produce 13.8 million barrels a day. They would love to have what we have. So they've offset that with coal. So that's why they have 5,800 terawatt-hours of coal-fired power generation, because when they when they push people to buy EVs, that offsets oil demand, and they're energy secure for coal and becoming increasingly energy secure using power to offset oil. So they're stockpiling all the oil so that they don't ever have to worry. So I heard this a lot when I was in London. I hear this a lot from different groups, is that, okay, at this price point, they won't stockpile. In their fourth plenum meeting that they just had, they actually said we're going to increase stockpiles, and they're already probably stockpiling 1 to 2 million barrels a day, or have been since COVID. And their economy has declined, yet their demand has gone up, which hasn't made any sense. So they are stockpiling. So I don't see an end in sight. I think they will continue to build out incredible storage. I think they're doing a lot underground that we are not seeing. I think it's being missed by data sources like Kepler. And that is definitely supporting oil prices to a degree. I don't see it actually ending. I don't think it's going to roll over. However, the impact, if they choose to impact the market, they could. They absolutely could. But then I would say, just to add, they have 18 million barrels a day refining capacity. So if you were worried about Russia losing refining capacity because Ukraine is plinking off some of their stuff with drones and everything, one, you can retool those pretty quickly. We saw that in World War II. It's very hard to actually hurt infrastructure, and you can bring it back online. But two, China can just refine the crude for them and give it back to them. And I would bet they're probably already doing it, because you can put crude and product in rail, truck, barge. It's pretty simple, so they can offset this.
Next question, at the back.
Yeah, I work in the financial markets on a global basis on the insurance side for utilities. And what we're seeing is the regulatory environment in the U.S. is easing up, but the financial environment from the banks and the insurance companies are going the opposite way. So there's a major disconnect. How do you see that shaping up?
So there is a disconnect, and I would say it's not clear across the board. I was just listening to Squawk Box this morning, and they were talking about the Trump administration going after entities that are promoting, like the Vanguards and State Streets and everybody who's pushing, when you put your money into their thing, that they're pushing this ESG stuff, that they're pushing back against that. So I hear a pretty mixed bag from those who are raising money, saying we have a lot of pressure that we can't actually get the capital, versus a lot of money that's chasing yield that is now increasingly being interested in oil and gas. But if you look like a state like Colorado, you look like California, the regulations are going one direction. You can't get resources, you can't get access to it. So, but in terms of the financial market now, and I said this before Trump got elected, but when you pull out of the Paris Climate Accords and you send all these signals, you are sending a signal to the market that the U.S. is a place to invest in oil and gas. So it does make it a lot easier for funds to say, I want to go after a public company and go for a long only in my portfolio. And so that's really, it's why, and I've said this a lot, folks, but so important for everyone in this room. And she talked about it, like Harold Hamm, he talks about it. And oh my gosh, you have to get in front of people in Oxford, you have to get in front of people in Washington, and you have to own this stuff. And you have to be very proud of it and deeply passionate, because if we don't talk about our industry, no one's going to do it. And they don't understand it. I always say this to folks, is that energy is hard to understand. Electricity is really hard to understand. But most people don't even know that we're the largest oil and gas producer in the world. And so that information has to get out there. It isn't in the marketplace. So what I started with, that pessimism and lack of understanding, we really have a very thin understanding of oil and gas and traditional fuels in the publicly traded stock market. It's very, very, very thin. And that's partly because a lot of public companies just, bent the knee and ducked and covered under Biden and started talking about wind and solar and renewables and all kinds of craziness. And they stopped talking about producing oil, and they need to get started back. They need to start talking about that more so that the market understands it, so it can be invested. You have to tell your story to your investors to get the dollars. And that has to be done across the board through every different sector.
All right, Sarah Kern, last question.
Yeah, my question is about how you see the newer U.S.-based enhanced geothermal playing up into the power generation landscape. So like the Fervo and Ever stuff.
Yeah, it's a great question. And somebody could ask about nuclear. So geothermal has a place probably in certain areas. There's a cost element to it, right? And there's a scale, right? How widespread you can get it, and can you scale it? You have to have in certain areas. I think it's a little, at the moment, I think you're gonna have to get the cost right, and you're gonna have to, the scalability is not there. From my understanding, it's not quite there. Like, can we just shove it into the grid and everywhere? But in certain locations, absolutely. And I do think it should be talked more a little about of these backstops, behind the meter, all these things, is that geothermal could present themselves. At the moment, I think natural gas should win the day. But people are talking about geothermal, and geothermal honestly is way easier right now than nuclear. And I'm pro-nuclear, but I just don't think SMRs are exactly, that's not going to just move the needle on people not wanting nuclear, right? So it's going to take a lot of momentum. And a couple of big ones get done, it's going to be a lot easier.
All right, let's give Trisha a round of applause, please.